an internal. Ooh, okay. I forgot to ask them to turn that on. Okay. So you have
Yeah.
to,
Um,
yes, thank you. You have to ensure that an internal audit function is there to review the liquidity funding operations to ensure that the policies and procedures are being adhered to. Because it's one thing to have a document, it's another thing to ensure that, and the literature tells you that the liquidity management has to be the way in which the organization operates. Even the stress testing and scenario planning that takes place, that has to be treated as one of the exercises that the banking organization um, goes through. And they have to, it is recommended that the persons who implement that are separate and apart from the ones who operate on a day-to-day basis. So you have a risk management unit that would be responsible for the design of the stress testing and the preparation of these policies. And then the audit function would be to ensure that these policies, as approved by the board, and being reviewed on an annual basis. Even if they don't have to change them, they have to be reviewed. They have to ensure that they are in fact valid and still useful, and ensure that they're being adhered to. Um, ensure the selection and appointment of qualified and competent management to administer the liquidity management function. This is a very important, as I said before, this is the one of the more difficult um, risks to manage. And you want to make sure that you have competent people dedicated to keeping their eye on what is happening, reporting to the ALCO committee on an ongoing basis, tweaking their policies or their as they go, and ensuring that the intermediaries that they deal with are in fact approved and in good standing. Um, the the and recognize too that the the quality and attention to liquidity management is going to be much more robust for a large organization. Yes, yes, you still have to keep your eye on it, no matter how small the organization is. But the more complex it is, then the more you have to ensure that you have competent individuals and you have a system that allows you to be able to stay on top of the movements of funds in and out of the organization. The outline the content and frequency of management liquidity reports to the board. And usually, I would think for most organizations, this would be something that would go to the board at least whenever there's a board meeting. And of course, if in fact there was a situation that required closer scrutiny, then it could be more frequently. But certainly, that's an important report to be reviewed and explained at board meetings. The business owners and ALCO are the first line of defense, with management, the management risk committee and the executive management. And the CFO and the chief risk officer and the treasury officer, they're the second line of defense because they're the ones who must put in place the system and strategy for the liquidity management. They're the standard setters. They maintain the stress testing procedures. They recommend scenarios the reviewing and monitoring components of the institution's asset and liabilities. They will recommend to ALCO what needs to be included when they're doing stress testing, and what kinds of assumptions they need to make, and making stress test liquidity reports which reconcile to the liquidity stress test data of the baseline balance sheet. And of course, remember, we were talking about ensuring that, that you have an understanding of really what the ebbs and flows are in the cash in the bank at different times of the year, and also to make sure that that is being tracked in case there are any changes in the expectations of and happenings in the organization. One of the things, certainly, when organizations focus on retail, there is less likelihood that you would have a run unless there was a real crisis, because each individual is less likely to have an impact on liquidity of the organization. But when you have institutional players, you could find that one institution that decides not to roll an investment could in itself, if it is considered part of the regular funds in the organization, you could find yourself in a situation where you have to put one of your strategies in place because of a major withdrawal of funds, or a roll, because a roll did not take place. Yes, Melanie.
Right. Sorry, just clarify something for me. The CFO and the Chief Risk Officer, wouldn't they report up to the ALCO and the Risk Committee respectively? I was just
Yes.
wondering why you have them
Yes.
as set out in terms of the lines of defense.
Yes, but they report to ALCO, but ALCO is the management committee that the reports go to and decisions are made. But what would happen is that the chief risk officer, they are the ones who would actually be recommending or putting in place the stress testing procedures and so on. And the ALCO, what they would probably do is take it to ALCO for ALCO to sign off on it. But the ones who are executing it in the organization is going to be usually the CFO or the chief risk officer. And the CFO, because the organization is small. If the organization is not small, they also have a chief risk officer whose responsibility it would be. The CFO would be involved as well, but the chief risk officer is the person who would really be determining or making recommendations with respect to stress testing scenarios and carrying them out.
Okay, all right.
Yeah. Mm-hmm. The reviewing and monitoring components of the institution's assets and liabilities. And also you must remember that the chief risk officer, CFO, they're the ones who would also not only be taking reports to ALCO, but they will also be taking reports to the board.
Right, because I was about to say that the
yes.
usually
but
comprise
in the organization,
and
yes,
comprises of board members.
Yes, but well, no, usually the ALCO is management.
Okay. I think in our space, some board members sit on it.
Okay. And which organization is this, if I might ask?
The credit union.
And you know why? It's the size of the organization. It's the size of the organization. because what you'll probably find is the much larger institutions, there may be a director on it, yes, because that person may have a particular skill that that the institution recognizes. But usually the asset and liability committee is comprised of senior management, because they're the ones who are going to be looking at their investments, their securities. They're the ones who are going to be identifying the intermediaries that they're dealing with, identifying what kind of limits and exposure they will have to each one of them. Where the deciding what kind of investments they're going to make in terms of the timing and how that ties in with any maturities that they have to deal with, and reinvestment costs and so on. That's what happens at ALCO. So it
Okay,
usually,
yes, because in our case, the treasurer of the board is definitely plays a significant role on the ALCO, because that person is responsible for the financial administration of the credit union. So they
okay,
definitely would have to sit on.
okay, yes. So because that in itself is, when you talk about administrative role, that is more than just that is more than the board member. I could understand if it's like the CEO. The CEO will be on ALCO, but the CEO is also on the board. May very well be a board member, and even if they're not a board member,
Well,
they
not in
would
our
sit on the
case.
board, right? Yes,
Not in
yes,
our
okay.
case. The CEO reports to the board, but they don't
Yes.
sit on the board.
Oh, okay. Okay. Yes. It varies. It varies. It varies. Yeah. Okay. Any other comments? And what you must bear in mind, is that this will differ from organization to organization, but especially if it is a smaller organization as opposed to a money center bank, because what it means is that it just has to do with the resources that they have to 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 focus on each aspect of their business. You know, that is that will determine, if it's a small organization, you may have two people, whereas in a big organization you may have a department that is dealing with this whole matter of the risk and making the determination. And it depends on what kind of computerized systems they have as well, you know. Yeah. Okay. Risk management is accountable for providing independent oversight of liquidity stress testing together with other programs relative to components of the liquidity risk management program. They're accountable for administering the policy regarding liquidity stress testing, reviewing and providing a practical challenge of the scenario design and assumptions, ensuring the institution's method of liquidity stress testing follows acceptable industry practices and regulatory rules and guidance. And of course, what you have to bear in mind is that invariably, certainly in terms of Jamaica, we have a situation where even the stress testing is guided by the regulators, because we're still in the process of trying to come to terms with what is the capital adequacy and the exposure of different types of banks, or different sized banks in the economy. So we're still trying to come to terms with what kinds of regulatory framework to put in place. It's still morphing. Um, the reviewing and approving liquidity stress test based limits, monitoring liquidity stress test, monitoring, reviewing and approving, monitoring it, ensuring that ALCO is informed on the bank's risk profile, liquidity risk profile. Then the internal and external auditors, they're going to do assurance, because that's really what the internal auditor does, by checking to ensure that the policies are being adhered to, and the reports truly reflect the situation in the organization. They are the third line of defense, and they report into the audit committee, which is a board committee. And so you have independent oversight function, so that the internal auditor, just like the external auditor, they're not involved in the money-making practices of the bank. They are there to provide assurance, ensuring that policies, not just liquidity management policy, but all policies are being adhered to, they're adequate, and they provide that report to the audit committee or the board, depending on how the organization is structured. They do periodic reviews of liquidity stress testing framework, the procedures and controls to keep compliance with policy, regulatory, and control requirements, and they report to the board or audit committee. So that's the third line of defense. Okay. Management is responsible for managing and controlling the day-to-day liquidity of the institution according to the liquidity management program, for developing and recommending liquidity and funding policies for approval by the board, implementing that approved policy, ensuring that liquidity is managed and controlled within the liquidity management and funding management programs, ensuring the development and implementation of appropriate reporting systems with respect to the content, format, and frequency of information concerning the institution's liquidity position, to permit the effective analysis, sound and prudent management and control of existing and potential liquidity needs. So that's what management's job is. And the liquidity risk management policy governance framework, there are established lines of authority and responsibilities. There's articulation of the liquidity strategy, established liquidity risk tolerances, regular communication between management and board, and broad representation from major operational areas of the bank on the liquidity committee. You know, I remember when I started out first, the Glass-Steagall Act, which was certainly in the United States, and so we operated in the same manner in Jamaica. And what we found was that the investment arm of the organization never spoke to the banking arm of the organization. And so when you had an ALCO meeting, there was an ALCO meeting for the investment arm separate as an ALCO meeting of the banking arm. Well, that doesn't apply anymore. When you have an ALCO meeting, you have representation right across the organization, because there's a possibility that the same major institutional client could be a depositor in the bank, and the institutional client could be a major client that they are the broker is doing funding for or has investments for. So you know, you want to make sure that when you're looking at liquidity, you want to make sure that you have a full view of what the risks are with respect to who your clients are and how they are in fact likely to impact the liquidity of the bank. Excuse me. My apologies. Yes. Yes, so with the liquidity stress testing, you have to identify the risk drivers. For instance, you want to make sure one of the main things that would impact liquidity risk is that mismatch of asset maturities and liabilities. Then you want to be mindful of the possible erosion of value of liquid assets. Market value matters. The additional collateral requirements that you may need. Identify liquid and illiquid securities. Only equity capital is patient, as I say. They're the only ones that will wait. Then there's evaporation of funding because of flight to liquidity. And the flight to liquidity doesn't necessarily mean that your organization has a negative report. It just means that based on what is happening in the environment, the clients may feel that their funds are safer with another organization. And that's what you talk about when you say flight to safety. They may be more comfortable with large money center banks that may not even give them much of a return, if any, on their funds. But if there's a concern, then they will feel that that's where their funds will be safe. And they're not looking for a return on their money. They are just looking on being able to have their money in a safe place. The design of stress scenarios and probabilities. External scenarios, emerging markets crisis, systemic shocks in main areas of the business, and market risk. Internal scenarios, operational risk, rating downgrades. Because, pardon me, the tendency is to be looking outwards and saying, well, what is happening in the marketplace? Where are interest rates? What is the market liquid? Is it not? But there's also the possibility that when you talk about operational risk and in an internal scenario, what is the possibility that there could be a downgrade in the organization's securities? And so therefore, the cost of borrowing by that organization is going to change. And sometimes that can happen because of a major debtor who is having operational issues unrelated to the bank. But because of that, the bank is impacted because now their liquidity is going to be impacted. And of course, what they call ad hoc, which is country, industry, non-specific, because it's just a general climate that will have impact on the institutions, the banks operating in that environment. So these are some of the things that will impact stress testing. You want to construct, generally speaking, it is constructing a cash flow model that, as much as possible, precisely and accurately measures components such as liquid asset buffer, stressed fund inflows and outflows, and stressed liquid asset buffer. So what we're talking about is ensuring that in bad times, the organization is covered. Okay? The liquid asset buffer comprised of unencumbered assets to meet market and operational obligations, and that would ensure that there is some liquidity that you can generate. If you have low credit, and market risk actively traded in a sizable market, ease uncertainty of valuation, and low concentration of buyers and sellers. That is a situation. That's what a liquid buffer is going to assist in. So you're going to have unencumbered assets easily convertible to cash. And they're there to ensure that certainly if there are credit concerns, and the market, you can be crowded out in a market where, especially if you have low credit, it's difficult to get funds to borrow when there's a crisis, if in fact your organization is not strong. Because what will happen is that other money center banks will be more comfortable lending to organizations that have strength, or which is not, or it's the reflection of it, the kind of interest that they're going to charge is going to be one that will be creating an additional stress on the organization. Stressed outflows result from the need to prematurely settle non-contractual maturity obligations and an incapability to fund contractual maturities that could roll under normal conditions. And this is when excuse me, although there is a maturity, because the particular investment always rolls, then it is regarded as part of the stable funding that the bank has, and that can change. These could include retail deposit outflows, unsecured wholesale funding outflows, loss of funding for asset-backed securities, secured funding runoff, drawdown of credit and liquidity facilities in excess of what was anticipated. We're all right?
Yes, yes.
Okay.
Yes, we're good.
The stressed inflows offset outflows partially. Includes funding transaction maturities, drawdown on available liquidity facilities, loan repayments from customers, to the extent that market conditions do not reduce in each stress situation. Stressed liquid asset buffer is the net of the stressed outflows less stressed inflows in a stress scenario. All right, liquidity stress testing. Step one is to quantify the liquidity outflows for all scenarios, for all risk drivers. Then identify each inflow to mitigate the liquidity shortfalls you identify, and determine 3, the net liquidity position under each scenario. Especially with a fallout in the banking sector, transparency and disclosure must be improved to rebuild trust, with savers, investors, the general public. Other issues that you have to be mindful of as well is intraday liquidity, because it's not just what happened at the end of the day, it's what happened during the day. Transfers between related entities. Currency, if there are overseas entities involved. The investment risk. Active managers are on the hunt for alpha, which means profit, or earnings above what you expect your normal return to be for the risk. That is the measure return. Alpha in finance, often used in portfolio management, is a measure of excess return representing the amount of return that a portfolio generates that is not explained by a benchmark's return. Visually, it's represented by the distance between the x, the y-intercept, and the intersection of a regression line with both axes, which can be positive or negative. And the formula here, what we're looking for is the alpha, which is the portfolio return minus the risk-free rate plus beta times the net of the market return and the risk-free rate. And really, what we're doing here is saying, well, what is the alpha of this return? Have we gotten a return that, or earnings, return, that is in excess of what we would normally expect for the level of risk exposure that we have? So when you hear portfolio managers saying that their fee is more than some other service provider because they provide the alpha. What they're really saying is that they provide the return over and above the level of risk that you face. So what we're trying to find out here is what is the alpha, and the alpha is the return that the portfolio provides minus the risk-free rate plus beta times the net of the market return and the risk-free rate. And that is your alpha. And then once you get your alpha now, let me see, yes. Once you get your alpha, whoops, what happened here? Yeah, where am I? Did I jump this? Yes, I must have. If the level of market and systemic risk were the only influencing factor, then the portfolio's return would be equal to a beta adjusted market return. So what it is saying is that you would always get the return that you are due because of the risk that you take, the beta. But this is not the case. Returns will vary as a result of a number of factors. And an important one is the investment manager. Yes, I left out this slide. And the investment manager who follows an active strategy will take on other risks to achieve excess returns over the market's performance. And how? By the particular stock that they pick, what sector they're in, what country they operate in, and of course, what are the fundamentals and the fundamental analysis that they're doing to ensure that the issuer is strong and in a market that's growing, and of course the charting. What is the resistance point on this particular price, and they can as it were work out when a stock reaches a particular point and it's likely to fall back, or it reaches a particular point and then it surges forward and creates a new high. That's what the charting does. And there are some people who invest in securities based on the charting and pay scant attention to the fundamentals. And those are primarily what they call the day traders. The day traders. Okay. So active managers are on hunt for the alpha, right? Which is this excess return. And this is where we were. And so what we're saying here now is that if it wasn't for the fact that these portfolio managers or those who have great experience with managing portfolios, they're the ones who investors seek out to try and give you returns over and above the level of risk. And so I would say that some of our portfolio managers will give returns way above the market or in excess of where the other competitors are. And that is because of the kind of research that they do. And they have an understanding of how the market operates. And sometimes it's just luck. Sometimes it's just luck, because that's part of it too. But we'd like to think that most of it is research. So you can have positive alpha, negative alpha, zero alpha, which is just where you're getting what the market is supposed to provide. And so the portfolio return, let's say, for example, the portfolio return was 15 and the risk-free rate was 3%. These are all percent. The beta is 1.2 and the market was returning 12. Then what is the alpha here? The alpha would be equal to the portfolio return, which is 15%, minus the risk-free rate here, plus the beta times the market return minus the risk-free rate. And that, when we're done, was equal to 1.2, what is that, 1.25? 1.2. We'll call it 1.2. That means that the portfolio earned 1.2 more than the expected amount that you would expect for it to earn just based on the market's performance. I can't see here. This is 1 point. What is it? 1 point. That's 139. Yeah. 139. What does it say here? Investment risk alpha. And of course, these are my old notes, so I'm not on the same note page. Yes, 1.2 I have here. So what is happening now is that they're earning 15 minus 13.8. The alpha is 1.2. So what they're saying here is that the return is slightly more than market, because what we're saying here is that market would normally be 1, which means the portfolio earned 1.2 more than the expected based on its risk level and the market's performance, because the portfolio return is going to be if the portfolio is returning more than the market expectation is at that level, at that alpha level, then you can only explain it based on the asset manager or the portfolio manager and the way in which they have identified, or rather taken on, additional risk to give a higher return. And of course, it can go the other way. It can go the other way. So you can find that the return will be lower than one would expect to have. So this alpha is coming out at 1.29, so therefore it's definitely performing 1.2%. What is happening is, I said, you look at percent side, it look like 1.2%, which means that it's 2% ahead of what one would expect for the level of alpha. So in our quest for excess returns, active managers expose investors to alpha risk, which is a risk that their bets will prove negative rather than positive. For example, A manager may think that the energy sector will outperform the Standard & Poor's 500 and increase the portfolio's weighting in that sector. If unexpected economic developments cause energy stocks to sharply decline, the manager will likely underperform the benchmark, which is an example of the alpha risk. And you can see, I mean, if you see what is happening globally, where the technology stocks have literally taken over, all because of the potential for AI to outperform, and because they are securities or they are companies that are involved in technology and the use of artificial intelligence, they really have been leading the market. Yes. If the level of market or systematic risk were the only influencing factor, then a portfolio's return would always be equal to the beta adjusted market. Okay. In our quest for excess returns, active managers expose investors to this additional risk, right? And if unexpected economic developments come along, then there is going to be fallout. And you see that happening, depending on, whether there are going to be tariffs or not, or there's going to be a war or not, then what will happen is that sometimes the entire market will move. But because investment in stock is considered as long-term, they'll say, well, okay, you might have an unrealized loss, but you're not going to sell because you know that the fundamentals are in support of you. But in North America, they're able to sell short. And so therefore, if you know that the market there's some reason why the price is going to drop, then if you're able to quickly sell your security before the price drops, and then you repurchase the same securities at the new lower price, that in itself allows you to earn a return. Okay. The price risk. We talk about investment risk. The price. There are economic consequences to the decision between passive and active risk. In general, the more active the investment strategy, right, the more alpha a fund manager seeks to generate, that is, the more an investor will need to pay for exposure to that strategy. This strategy could span the spectrum from a purely passive approach, which is a buy and hold, all the way to a highly active approach, such as a hedge fund employing complex trading strategies involving high capital commitments and transaction costs. For a purely passive vehicle like an index fund or an exchange-traded fund, you may pay 15 to 20 basis points in annual management fees, while for what we call a high-octane hedge fund, you would need 200 basis points in annual fees, plus give 20% of the profits back to the manager, because what he's saying is that because of my unusual scale, then what I'd like to do is to share in the upside. In between these extremes lie alternative approaches combining active and passive risk management, such as an ETF, right, exchange traded fund with active management. Okay, so just so you know that when we talk about an index fund, right, it means that you have bought into a fund that is tied to a particular index. And so what will happen is that they will imitate the fund that they are indexed to in terms of the percentages of certain kinds of securities, with the expectation that the outturn is going to be in line with the fund to which it's indexed. Okay? So that's why they call it passive, because really the investment advisor is not making investments looking for the alpha. What they're doing is trying to imitate the holdings in the portfolio so that they come out with a return that is similar to the fund to which they are indexed. In between the two extremes lie alternative approaches. So the difference in pricing between passive and active strategies encourages many investors to try and separate these risks. That is, to pay lower fees for the beta risk assumed and concentrate their more expensive exposures to specifically defined alpha opportunities. For example, a fund manager may claim to have an active sector rotation strategy for beating the index, the Standard & Poor's 500, and show as evidence a track record that they have been beating that index by 1.5% on average on an annualized basis. To the investor, that 1.5% of excess return is the value that the manager brings. And for that reason, they will be expected to or want to pay higher fees. The risk, in conclusion, the risk is inseparable from return. Every investment involves some degree of risk, which can be close to zero in the case of US Treasury securities, or very high for something such as concentrated exposure to emerging market equities or real estate in Argentina. Risk is quantifiable both in absolute and relative terms, and investors must have a solid grasp of risk in its different forms to better understand the opportunities, trade-offs, and costs involved with different investment approaches. What time do we usually take a break?
I believe 7.
7. Sorry, go ahead.
7? So we have 10 minutes. Okay.
Yeah.
All right. The next area that we're going to be looking at now is what I call traditional Markowitz portfolio theory. It derives the expected rate of return for a portfolio of assets at an expected risk measure. And Markowitz demonstrated that the variance of the rate of return is a meaningful measure of portfolio risk under reasonable assumptions. Markowitz showed that for a given level of expected return and a given security universe, which is the entire collection of investment options that you have, from which specific investment decisions are made, finding the specific portfolio that dominates the others requires a knowledge of the covariance and correlation between all of the security combinations that are available. Right? Now, the portfolio variance formula shows how to effectively diversify a portfolio. One of the things that the Markowitz portfolio theory tells us is, or recommends to us, is the fact that we are encouraged to have a portfolio of investments, right? Rather than investing in one stock. That really is what the Markowitz theory has over time demonstrated, and the to this day this is still the case. To this day, this is still the case. Where am I here now? The calculations themselves, and I think I said it before, has been as it were taken over or displaced by the discussion about a portfolio of 25 to 30 securities. And what they're saying is that for the most part, any portfolio of that many securities is likely to have diversified away as much risk as you're likely to be able to diversify away. And what's likely to be left is the undiversified market risk. So, for the purposes of analysis and finance, we delve into the past because this is our history. This is our history. And here we are. So determining the expected rate of return, for instance, let me go back here. Yeah, okay. So the portfolio variance formula shows how to effectively diversify a portfolio. So that is what the Markowitz portfolio theory encourages us to do as investors. And in determining the expected rate of return for our investments, if we assume that the risk-free rate is 5% and the market return is 9%, then if we were able to calculate the beta for different stock, and remember now, the beta is based on historical statistical information, right? That speaks to how on average a particular stock performs when if there's a 10% movement in the market. What does this stock do? Does this stock also give you the same 10%? Is it less or is it more? And what they will do is, for purposes of beta, it's 1, which means that as in stock B that has a beta of 1, then here you would expect that this particular stock would give you the same return as the market, this one, right? If the beta is 1. But if the beta is 0.7, which is less than 1, it means that the movement in that particular security is going to be slower than the overall movement in the market. But when you look at stock F, which is a negative 0.3, what they're saying here is that this particular security is moving in the opposite direction, right? And it could very well be that this is not equity. It could be a fixed income security or something else that is impacted differently when the equities market is moving in a particular way, right? But it says stock. So let's presume, this could very well be, it could be stock that has some warrant tied to it for purchase of security, whatever it is. But it certainly is underperforming the beta here, right? Suggests that this particular stock is going to underperform. Okay. So here we have, in applying the calculation, right? We're saying, well, the expected rate will be equal to the risk-free rate plus beta times the expected rate of the market less the risk-free rate. And that is the formula that we use to calculate for each one of these securities, right? And what do we find? Just as we thought, the return that we're going to get from B is the same as the market return of 9%, right? Because it has a beta that is 1. And by the same token, A has a beta that's less than 1. And so therefore, one would expect a return that's lower than the market, and so on. Yeah? But if we had a situation where we got a return from the security that was in excess of what one would expect for that particular beta, then that's where it is an indication of the expertise of the portfolio manager, who is taking on usually additional risk, you know, alpha as they call it, to give you a higher return. Okay. So what are the basic assumptions behind the Markowitz portfolio theory?
I'm
Well,
Shirley, not to interject.
yes.
7 p.m. 7
You see
p.m.
how that
Yeah.
you saw that 10 minutes went fast?
I
That's
know,
what I was
right?
asking in case we'd break before I started this. All right, so we'll take our 15 minutes.
Yeah.
Okay. Dennis, you're staying with us?
Yes, I'll stay for another half an hour.
Okay, great. Okay.
Thanks for
Okay.
asking.
So let's just so we come back at quarter after and continue.
Alrighty.
Okay. We all back?
Yeah, I'm here.
Yes, I'm
Okay.
here.
Right, wonderful. So let us continue.
Can I ask a question and make a comment before we move
Sure,
on?
sure.
Yeah. All right. Okay. So earlier on, we were talking about the liquidity coverage ratio, and you mentioned that it's one of those ratios that's used under Basel III for stress testing.
Mm-hmm.
And it's important from the perspective of how it's used currently in the banking sector, because there's a requirement by the Bank of Jamaica that DTI should report on it on a monthly basis.
Monthly basis. Mm-hmm.
Right. But typically, well, I shouldn't say typically, but some banks also, as part of their management of liquidity risk, calculated on a daily basis.
Mm-hmm. Yeah.
So they would look at the high quality liquid assets, the unencumbered high quality liquid assets, and compare that with the net cash flows using the BOJ's assumptions, because the BOJ actually submits those assumptions.
Mm-hmm. Yeah.
So I want to share that along with the fact that it's done on a combined basis in terms of currency. So, but it's also done on a per currency basis. So to the extent that you have significant US denominated or Canadian or sterling denominated deposits, you would also have to ensure that you meet that requirement of 100% on a per currency basis and on a combined basis.
Yeah.
So I want to share that. The other point I want to kind of get some clarity on is in relation to the investment risk now when we speak about the beta. So
Mm-hmm.
again, you mentioned about the beta being one, being a perfect correlation in terms of the security, the
With the
securities
market.
movement to the market,
Mm-hmm.
right?
Mm-hmm.
So it means that in the case of the 1.2, it would suggest that the security moves, is it 20% more than the
20%.
market?
Yeah.
Yeah. All
Yeah.
right. And in the case of this is the tricky one now. In the case of the negative 0.3,
Mm-hmm.
it's a inverse relationship. And so does it suggest that if the market goes up, say, by let's use percentages, 1%,
Mm-hmm.
then the asset will go down by 0.3%,
.3.
and the converse would hold.
Yeah.
Okay.
Yeah.
All right. Thanks for that.
Yeah. There was in the days when um designing a portfolio had to do with being familiar with how each security in the portfolio moved with the market, with the expectation that when you were done, you ended up with zero. I don't know if finance measures. They used to tell us that what you try to do is to identify securities in your portfolio, which is why you would have fixed income and equities and preferentials and what have you, all in the same portfolio, because really what you want to do is you want to be able to balance the risk so that you have negatives and positives, right? Moving in relation to the market so that you almost end up with a zero. So that means that you did not have to worry about risk that much, especially downside risk. Yeah, that is.
Yeah, sure, agreed.
Right.
And you made a reference to the 25 and 30 securities. I guess that point will be more so important too, because you don't want to be investing in 25 to 30 securities that are in the same industry, for example, because those will not necessarily have the negative correlation that you mentioned earlier.
Exactly,
Right.
exactly, exactly. And what is interesting is that what they're now saying is that rather than focusing, listen, rather than focusing so much on the beta and whether it is positive, negative, or zero, or one, rather, one or above, or one and below, you have that 25, 30 securities, then unless they're all in the same, the presumption is that there's diversification. So it's not that you're investing in securities that are all in the same market, you know, the same industry.
Right.
Then what they're saying is that that in itself is going to give you as much diversification and risk reduction as you're ever going to get. And the analysts say that they have done the research, and in fact that is the case. And so what that does now is that it allows individuals to have, and I say individuals because when you have many securities, everything has to be done only by the computer analysis, But what they're saying is that in a simplified form, you have the diversification of risk, the diversification to reduce the risk as much as you can. So, what can I tell you? So whereas what was 1952 when Markowitz came on the scene, and everybody spent all their time on their computers trying to ensure that their portfolios were identified securities that were negative and positive, or fixed income and equities, as the case might be, to give you that balance, so that if the equities market went down, then chance because of rather you could say if interest rates went up, then all things being equal, the equities market would go down because people would be concerned about the cost of capital. But the fixed income holdings in the portfolio would go up because you'd be earning a higher return. Simplified, but of course, it doesn't always work that way because interest rates go up, and if your securities are earning a low return, then what will happen is that nobody wants to buy them. And so what would happen is the price of those securities would go down. It's quite interesting. What else can I say? But as you can see, as they call it, chasing alpha is the way to go. You invest in a portfolio that is managed by a professional, money manager. And if in fact they are very active, then they're going to charge higher fees than an index fund. So, all right. So here we are. What are the basic assumptions behind Markowitz theory? As I started out, investors consider each investment alternative as being presented by a probability distribution of expected returns over a holding period. So in other words, you can't speak to what happened before you bought the securities or after you sold the securities. It's just as long as you are invested in it. Investors minimize one period expected utility, and their utility curves demonstrate diminishing marginal utility of wealth. And what that really is saying, that the more you have, the less impact that has on your store of wealth. So if you have one security, then that security is going to be determined in a simplified way, your return, because you only have that one. But if you have several, if you have those 30 securities in your portfolio, then getting 31 is going to have a less of an impact on your total holdings than if you only had one or two. So it's like the more you have, the less impact it's going to have on your wealth, your marginal expectations. And investors estimate the risk of the portfolio on the basis of the variability of expected returns. So in estimating what the total portfolio is going to provide to you, you have to look at the totality of the total amount that asset in the portfolio brings to the table. And of course, investors base decisions solely on expected return on risk. So their utility curves are a function of the expected return and the expected variance, or standard deviation of returns only. So in trying to determine how you make an investment, your interest, which is this utility curve, it's going to be tied to what your expected return is and what your level of risk is in that portfolio. And for a given risk level, investors prefer higher returns to lower returns. And similarly, for a given level of expected returns, investors prefer less risk to more risk. What do we mean by risk? And what are some of the measures of the risk used in investments? Well, under these assumptions, a single asset or portfolio of assets is efficient if no other asset or portfolio of assets offers a higher expected return with the same risk level, or lower risk with the same expected return. So really what we're doing is we're trying to identify a portfolio of holdings that will give us the highest return for the risk that we're taking. Variance or standard deviation of expected return is the main focus, and it's based on deviations from the mean or the average return. Larger values indicate greater risk. And other measures, such as the range of returns, returns below expectations, when I talk about semi-variance, because sometimes people are only interested in the likelihood of loss rather than the total. And individual risky asset, the weighted average of all possible returns, the probabilities serve as the weight. And so, in other words, what is the probability that the investment that I make is going to give me a 10% return? well, the weighting, you're going to multiply that by the return, because the probability is the possibility that you're going to get a return. The portfolio is the weighted average of expected returns for the individual investments, and the percentages invested in each asset serves as the weighting. Okay. And so the expected return of the portfolio is going to be equal to the sum of the weighting in that particular security times the return for that particular security. And if you have several of them, then it is the totality of them all. Okay? The sum of sigma. Individual investment. Standard deviation is the positive square root of the variance. You will recall when we started out, and we were saying that in risk, the standard deviation is what we tend to look at, or what we used to look at. But now it's just one of a range of variables that we use in determining our return. But when the Markowitz started out, standard deviation was in fact the measure that we used, and that was it. That was it. Both measures are based on deviations, each possible return from the expected or average that you expect from the investment. And the variance is the square root of it. So the variance is equal to the sum of the probabilities of J times the rate of return that you have gotten this time minus the expected return squared. So really what is happening here is to put it in words, when you're making an investment, what you would have done, assuming that you have done your homework, you would have said, okay, I'm going to make this investment because it is going to give me a 20% return. And why? Because that is my expected return. So what may have happened is that analysis would have been done, and data would have been collected, and they would say this kind of investment, for argument's sake, is going to give a 20% return. Okay? And so because my expectation is on average, I'm going to get a 20% return, I like that investment. You know, that's a good return. I'm going to invest in that particular security. So we're saying, okay, the probability, right, that I'm going to get this return maybe 60%, okay? Because it is more than it certainly is more than 50%, okay? So that's why I made the investment. But what did I get? Instead of giving me the return that I expected, I only got 40%. So really, or it could be that I got 80% return. The important thing is that I have a real recording of an actual return, and I'm comparing it to my expectation based on the research that I had and the probability of that happening, okay? And that is what we would call the variance. But I'm trying to find the standard deviation, and standard deviation, sorry, square, that's the variance. But standard deviation would say it is the square root of the variance. Okay? The square root of the variance. So the variability of the return is what is going to feed into the standard deviation of the return of that particular security. So if we knew all the possible returns that an investment might earn and the probability of each outcome, then we could calculate the variance. For example, a firm is waiting a court's decision on a product liability litigation. If found in favor of the firm, their stock is expected to go up 15%. And the probability of that happening is 55.55, a little more than 50%. So in other words, their expectation is that the litigation is going to rule in their favor. But if the firm loses their case, then their stock is going to drop 10%. So the expected return and variance are as follows. The expected return is the 55%, the 0.55, which is the probability that they will earn 15%, plus the probability that they will lose, because you have to look at the totality. If 55% is that you're going to win, then 45% is that you're going to lose. And if you lose, then the stock falls. So the expected return is the totality of winning and losing, right? Which is 3.75. Now the variance is the same squared plus the probability, which is what we're saying now, is that the probability that you're going to get 15%, right? The expected return is 3.75%, because we just calculated it up here. And the probability that you will lose and it will fall by 10% is still 3.75. So the total variance that we're looking at is 154.7%. Well, what is the standard deviation? The standard deviation is nothing more than the square root of that variance. So in other words, if you were looking at securities, you'd have to calculate you have your portfolio and you have the earnings on your investment. And you'd have to compare what is the probability that I have, well, your probability will be based on your analyses. And it will tell you that more often than not, you get a return of X versus Y. And so therefore you have past experience that is giving you these probabilities that you are utilizing on the return. And the standard deviation, so what you would do is that you would have to add every one of those experiences that you had in terms of an actual result, okay? And arrive at the variance. So in other words, you would have a stream of returns that you would have added, and then you would have squared it, because remember, variance, it is the probability times the expectation, right, minus the expected return. And you're doing it on both sides. So when you get to the variance, you have to find the square root of it. That is the standard deviation. So what that will do now is tell you that whatever result that you are getting, if the standard deviation is 12.4, that means it can move 12.4% positive or negative. Okay? That is just giving you the range. other measures that we need to look at is, and what I've done here is I'm putting these down for the simple reason that there's a possibility that you, starting here, there's a possibility that you may very well get a scenario, a similar scenario. And the expectation is that they would give you a range of results, right? And because you know that this is how you would calculate the expected return, right? Here, oops, oh dear. The expected return, then they could give you a range of results and ask you to identify which is the right one. Similarly, you could get a simple situation where you are presented with the variance and asked to identify the standard deviation, and they would give you a range of options to select which one is the standard deviation. And because you know that it's the square root of the variance, then it means that it's very easy for you to do that calculation, because remember, now you're not going to get anything that requires you to have a calculator, right? Okay. The covariance, pardon me, that's the extent to which two variables move together. So if we're looking at two assets, I and J, two securities, the covariance of the rates of return would be taken as the expected return of R for now minus the expected return, which is the result, minus the expected return, which is, as we say, the average, times the other security T in the same way, the result or the rate of return minus the expected return. That gives you the covariance. Okay. This one is really just for demonstration, because there's no way you're getting anything that has to do with these two. But what can happen is that you can be presented with be asked to find the covariance. And because what they're giving you here is the rate of return, IJ, and the variance, the standard deviation, right? Or they could give you the variance with the expectation that you'll find the standard deviation and be able to solve the covariance, because it is the multiplication, right? The portfolio standard deviation is a function of the variances of the individual assets that make up the portfolio. The covariance is between all the assets in a portfolio. And so that's why you recognize that this is not something all you're likely to get reference to is two items, two securities, because that is something that you can calculate quite easily. Because really the intent is really just to understand how it comes about. It's not in business today, we have at our fingers tip all of the information that we need online, so really what we're talking about is just to understand what it is all about. That's the main thing. The larger the portfolio, the more the impact of covariance, and the lower the impact of the individual security variance. Remember, we're talking about the utility, and the more securities that you buy, the less impact it has, the less impact it has on your utility. And that is because it has less impact on the result. And similarly here. Yes, similarly here. Assets differ in terms of expected rates of return, standard deviations, and correlations with one another. While portfolios give average returns, they give lower risk. Okay? Diversification always works. Even for assets that are positively correlated, the portfolio standard deviation tends to fall as assets are added to the portfolio. Combining assets together with low correlations reduces portfolio risk more. The lower the correlation, the lower the standard deviation. Negative correlation reduces portfolio risk greatly. Why? Because it's moving in the other direction. Combining two assets with perfect negative correlation reduces the portfolio standard deviation to 0. So you have one moving negative, one moving positive, then you have stability. Studies and mathematical models have shown that maintaining a well-diversified portfolio of 25 to 30 stocks yields the most cost-effective level of risk reduction. Investing in more securities generates further diversification benefits, albeit at a drastically smaller rate. Results of portfolio analysis depend on accurate statistical inputs. Estimates of the expected returns, the standard deviations, and the correlation coefficients. With 100 assets, 4,950 correlation estimates. Estimation risk refers always, because it's estimation, to potential errors. With assumption that stock returns can be described by a single market model, the number of correlations required reduces the number of assets to a single index market model. So here we are with the returns, right, from the investment. And what we have is the beta, right? And the beta is the slope. And that is telling you how it moves relative to the market, and times the return of the market, right? And always what they're saying is that because it's always an estimate, right, you're going to end up with errors. So that's what this situation is. Another risk measure oriented to behavioral tendencies is drawdown. And that refers to any period during which an asset's return is negative relative to its previous high mark. And we talked about that in our first meeting together. In measuring drawdown, we attempt to address three things: the magnitude of the negative period, the duration, and the frequency. And that is important when you're looking at estimating the performance of how the market moves by looking at the movement in the market rate. And remember, we said we're not looking here at the fundamentals at all. We're just looking at the movement in the stock price, the movement of the price on the market, and determining what are the resistance points. Then we know all about compound annual growth rate, right? Which is the year-over-year growth rate of an investment over a specified period. And this one is very simple for all of us. And I don't think we need to revisit this fella, but here it is, okay? suppose you invested 10,000 in a portfolio, and at the end it had grown to 13, then 14. Well, and then finally to 19. In doing the calculation, what you'd be looking at in a simple format is comparing that 10,000 to the 19.5, but you would have lost the benefit of the movement in the intervening period. And so really the compound average growth rate is going to be reviewed by looking at the movement, right? Not just the 19.5 and the 10,000 at the start and at the end. But what you're going to do is it's going to be raised to the power of 1/3, which is the number of years, right? And then subtracting 1 from the resulting number. So 1.95 raised to 1/3 is equal to 1.2493. So in other words, what they were saying, it is really 24.93% is the actual movement over the 3-year period. We did this already, which is a discussion of beta, right? Okay, we're talking about the beta based on the statistical property of covariance, and also called market risk, also called systematic risk, also called non-diversifiable risk, right? And beta greater than 1 indicates more risk than the market, and less than 1 less risk than the market. We discussed that already. And a portfolio of investments, the mean historical rate of return for the portfolio of investments is measured as the weighted average of the holding period yields for the individual investments in the portfolio, or the overall change in the value of the original portfolio. And the weights used in the computation are the relative beginning market values for each investment, which is often referred to as dollar-weighted or value-weighted mean rate of return. And so here we have an example with the 3 stocks, and this is the number of shares that we started out with, right? And this is the value at the beginning, and this is the price at the end of the year, the period, and then it has a new value, of course, you know, because now instead of $1 million, the portfolio is now $12 each, so it's 1.2, right? And so the holding period return would be 120, right? Because it's really 20%, 100 being where you started, and it has increased by 20, 1.2, right? 20, but it's really the yield, oops, the yield is really just the movement, because you're going to take away the 1, and it's 20%, right? And so what you're looking at now is the weighting, the weighting of the security to arrive at your holding period yield of 0.095. And of course, this is a calculation down here. The holding period return, right, is the value at the end times the value at the beginning, okay, 9.5%. And the yield, well, sorry, the return, which is the 1 point, because you're not subtracting the 1 at this point, but in actuality, really what it is subtracting the 1, and it is 9, because you know it's 9.5%. Okay. In previous examples, we discussed realized historical rates of return. In contrast, an investor would be more interested in the expected rate on a future risky investment. Risk refers to the uncertainty of the future outcomes of the investment. There are many possible returns or outcomes, right, due to uncertainty. The probability is the likelihood of an outcome, and the sum of the probabilities of all outcomes is equal to 1. You remember when we talked about the example that we had with the court case, that there was a 55% chance that they would win and a 45% chance that they would lose. And what is the outcome if you win, and what is your... That's really because it must always total to 1. Okay? And computing the expected rate of return is the probability of the return times the possible return, right? And what would happen is that you need to do that for all of the assets in the portfolio. Okay? So that's really what this is. The probability of a return for all of the assets 1 to 9, whatever they are in the portfolio. Risk refers to the uncertainty of an investment. Therefore, the measure of risk should reflect the degree of uncertainty. The risk of expected return reflects the degree of uncertainty that the actual return will be different from the expected return. The common measures of risk are based on the variance of rates of return distribution of an investment, right? So you're measuring the risk of expected return. And so what you're going to do, you're going to say the probability that I'm going to get a possible return minus what my expectation is squared. That is the variance. And the standard deviation is what? The square root of the variance. Okay? And we talk about we talked about the coefficient of variation, standard deviation of the return over the expected rate of the return. And the risk of historical rates of return, given a series of historical returns measured by the holding period yield, the risk of returns is measured as the variance is the sum of the holding period yield minus the expectation or the mean squared over n. And n, that's just the number of observations. There are 3 components of required return: the time value of money, the expected rate of inflation, and the risk involved. Okay, 3 components of required return: time value of money, the expected rate of inflation, and the risk involved. Complications in estimating required return. A wide range of rates is available for alternative investments at any time. The rates of return on specific assets change dramatically over time, and the difference between the rates available on different assets also change over time. So those are the complications that you face in trying to estimate what the required return is on any investment. The real risk-free rate, what that assumes? It assumes that there's no inflation. It assumes there's no uncertainty about the future cash flows. And it's influenced by time preference for consumption of income and investment opportunities in the economy. Okay? Whereas a nominal risk-free rate, the conditions in depends on the conditions in the capital market and the expected rate of inflation. So here we are, the real rate, real risk-free rate, right? Assumes no inflation, no uncertainty. And the only thing that's going to influence is going to influence by the time preference for consumption. So in other words, money now is better than money later. Whereas in the nominal risk-free rate, right, it includes the inflation, because what you're going to do is that if you say that my return is 9%, 9% is your nominal rate. But what is the real rate of return? What is the risk-free? What is your real rate of return? It has to be after you take out inflation, right? So that is really the difference between real and nominal. The nominal rate is what you get, but it is not. It doesn't describe whether you're getting a real return, because you could be getting a return that is less than inflation. So when you take off inflation, you're in negative territory. What is business risk? It is the uncertainty of income flows caused by the nature of a firm's business. Sales volatility and operating leverage determine the level of business risk. And financial risk, the uncertainty caused by the use of debt financing. Borrowing requires fixed payments, which must be paid ahead of payments to stockholders. The use of debt increases uncertainty of stockholders' income and causes an increase in the stock's risk premium. Liquidity risk. How long will it take to convert an investment into cash? And how certain is the price that I'll receive? And remember, we said that it has to do, when you're talking about liquidity management in the bank, it is meeting all your short-term obligations as they fall due. And your coverage must be 100%. Okay. Exchange rate risk. Uncertainty of return is introduced by acquiring securities denominated in a currency different from that of the investor. Changes in exchange rates affect the investor's return when converting an investment back into the home currency. And then there's country risk. And country risk includes political risk, which is the uncertainty of returns caused by the possibility of a major change in political or economic environment in a country. And individuals who invest in countries that have unstable political economic systems must include a country risk premium when determining their required rate of return. And what we're saying here, the emphasis here is on unstable. American businesses will invest in China. And they'll invest in China. Why? Not because they are attracted to communism versus capitalism, but because the rules of engagement are stable. It's a communist society, and they understand what the rules are, what role the government plays in the society, in the economic determination of things, and so therefore they can plan. And as they always say, businesses, they just don't like unstable political or economic systems. They cannot plan for the long term. Risk premium and portfolio theory. From a portfolio theory perspective, the relevant risk measure for an individual asset is its co-movement with the market portfolio. Systematic risk relates to the variance of the investment to the variance of the market. Beta measures this systematic risk of an asset. And according to the portfolio theory, the risk premium depends on the systematic risk. And really what they're saying here is that the systematic risk is that risk that cannot be diversified away. And so therefore, once the investor understands what the systematic risk is, then that will determine what additional return they will need to make them comfortable making that investment. Because remember, you have what you call the risk-free rate, right? And then you have what the market return is. And the difference between the two is the premium, the risk premium that the investor requires, right? Because of the risks that they face from participating in that endeavor. All right. Fundamental risk versus systematic risk. Fundamental risk comprises business risk, financial risk, liquidity risk, exchange rate risk, and country risk. The risk premium is equal to all these components. So whatever is that risk premium that one will put on the particular investment, that is because they have taken into consideration all these factors. Systematic risk refers to the portion of an individual asset's total variance attributable to the variability of the total market portfolio. And so the risk premium is always a factor of the systematic market risk. And I'll go back here where, see, we're talking here and saying that the risk premium depends on the systematic risk. That is the undiversifiable risk. Okay? And that is already taken into account in the beta, because that is what determines how the particular security is going to move vis-a-vis the market. Systematic risk refers to the portion of an individual asset's total variance attributable to the variability of the total market portfolio. And so the risk premium takes into consideration the systematic risk premium, systematic market risk. Okay? Similarly, the risk premium, that's what you're factoring in. The risk that I can't diversify away. And all of these things here are part and part, are part of this systematic risk, because they are the fundamental risk, right? Comprised of business, financial, liquidity, exchange rate, and country risk, which are all part of the risk premium. But also, risk premium is going to be the systematic risk that the investor cannot diversify away. So you need to make sure that the return makes it worth your while to make that investment. The relationship between risk and return. Here we see the security market line. And the security market line here, right, is the risk-free. It's that whatever is the risk-free, the risk-free, it's where it's going to start, the security market line. And this is the slope. And the slope indicates the required return per unit of risk. risk, return, risk, return, risk, return. Low risk, average risk, high risk. This is the expected returns. Yeah. So, yes. So, investors select investments that are consistent with their risk preferences. And so if you are someone who is you have a low risk tolerance, then you're not going to move far up the security market line. And of course, you're prepared to the return that you're prepared to take is going to be low as a result, you know. But if you are a risk taker, then you are going to expect a higher return for the risk that you're taking, because you're taking more risk because you are prepared to take it to get a higher return. So here we have the business risk and all the systematic risk down here. That's what this is. That's what that risk is. And this is the return that you expect to get because you have accepted these risks. And of course, movement along the security market line, when the risk of an investment changes due to a change in one of its risk sources, the expected return will also change moving along the security market line. It reflects changes in the risk of the asset. Okay? So you recognize that you're prepared to accept more risk for more reward, because one of the risk factors may have changed. But if in fact the change is in the slope, right, which is the caused by what they call here a change in the attitude of investors towards risk, then the slope of the security market line is going to change, because investors either become more or less risk averse, right? And so therefore, if they are more risk averse, then the security market line is going to be steeper, indicating a higher risk premium. More money, you have to pay me more money for the same amount of risk that I'm taking, right? The entire outlook has changed. The market has changed, and how it perceives this kind of investment. The change in the risk-free rate or the expected rate of inflation will cause a parallel shift in the security market line. When nominal risk-free rate increases, the security market line will shift up, implying a higher rate of return while still having the same risk, you know, while having the same risk. Because here it is, that was the original security market line. And what it's really indicating is the risk. This slope is just displaying the risk tolerance of the investors. Capital market theory, right, which is what Markowitz told us, introduced us to, extends portfolio theory to and develops a model for pricing all risky assets, right? While capital asset pricing model will allow you to determine the required rate of return for any risky asset. It's a powerful measurement of expected returns on risky assets. And of course, we know what the capital market theory says about the assumptions. We are risk averse, higher returns on risky investments. All investors are Markowitz efficient investors who want to target points on the efficient frontier. We can borrow or lend at any amount at the risk-free rate. All investors have homogeneous expectations. That is, they estimate identical probability distributions for future rates of returns. And all investors have the same one-period horizon, whether it's 6 months, 1 month, 1 year, whatever it is. So those are the assumptions that we have to make to apply the capital market theory, okay? So the uniqueness of investors goes through the window, right? What we're looking at is return to a level of risk. And the return, the expectation is what we expect. It is very what you call monolithic, that the entire marketplace, all the investors are of similar mind. All investments are infinitely divisible. It is possible to buy and sell fractional shares if that's what the money can buy. There are no taxes or transaction costs, no inflation or any change in interest rates or inflation is fully anticipated. Capital markets are in equilibrium, implying that investments are properly priced in line with their risk levels. And the capital asset pricing model indicates that expected return on a specific asset, which is expected return ER, equals a risk-free rate plus a premium that depends on the asset's beta, and the expected risk premium on the market portfolio is equal to the expected return of the market minus the risk-free rate. Because what we say is that the expected return would have incorporated the premium because it is not risk-free. Development of capital market theory, the major factor that allowed the theory to develop is the concept of a risk-free asset, an asset with zero standard deviation, zero correlation with all other risky assets, and provides a risk-free rate of return, and it will lie on the vertical axis of the portfolio graph. So when we were looking at our graph here, we talked about the risk-free rate. You know, here it is. But if you want to accept any additional risk besides the risk-free rate, which is government securities for argument's sake, and that is usually used as the base, then this line represents the additional return that factors in all of that nominal risk, or back here, what we call fundamental and risk premium, all of the fundamental risks, which boil down to the systematic risk that can't be diversified away. And what is this? This model describes the relationship between the expected return and risk of investing in a security. It shows that the expected return on a security is equal to the risk-free rate plus a risk premium, and that risk premium is based on the beta of the security. Below is an illustration of the capital asset pricing concept. The formula is used for calculating the expected returns of an asset. It's based on the idea of systematic risk or non-diversifiable risk that investors need to be compensated for in the form of a risk premium. A risk premium is a rate of return greater than the risk-free rate. So when investing, investors desire a higher risk premium when taking on more risky investments. And so here is the graphical representation of it. So here we have the return, and this is the beta, which represents the risk, the undiversifiable risk that the investor must treat with if they're investing in the market at all. This space from 0 represents the risk-free rate. And so the investor who is investing in risky securities, right, is going to expect to have a higher return than the risk-free rate, because that investor is investing in a security with a beta that addresses the risks that they face. And so it says here, the risk-free rate is normally taken as the yield on a long-term government bond in the country where the project or the company is based. Or it could be treasury bills. It's government securities. It could be well, usually 6-month T-bills, but it depends, whatever the government bond is. And the risk premium can be anywhere between 3 to 9% above the risk-free rate. So you have 300 to 900 basis points. And it varies. It varies because everything has to do with the risk, or the risk that the investor is prepared to take. This security market line, according to the capital asset pricing model, the equilibrium expected returns of all securities must plot on this line. Assets and returns above the line would be underpriced, and investors would snap up stocks, driving up prices and driving down the expected return until it reached that line. Conversely, assets and with returns below the line would be overpriced, and so investors would divest their holdings of these securities, driving down prices and expected return up until it reached the security market line. So here we are. This is the expected return, right? And this is beta, which is the undiversifiable risk. And so this is the risk-free rate here. And so the investments that would be made here on the security market line would represent equilibrium. And so if a security was giving this kind of return for this level of risk, then it's overpriced. Because for this level of risk, this is the expectation that the investor would like to have. And similarly here, for this level of risk, this is the expectation of return. And so if the security is giving you this level of risk, then everybody wants to get in, wants to buy it. And what that will eventually do is force the price down, supply and demand. And so this represents the equilibrium spot, which is the expected return of the market less the risk-free rate. Developing the capital market line covariance with a risk-free asset covariance between two assets of returns. And remember, we talked about the expected return of this asset minus the expected return of the asset times the return of the second asset minus the expected return of that asset over the number of observations, sum of, right? That is what the covariance between two sets of returns would be. And similarly, the correlation between any risky asset and the risk-free asset would be 0, since the covariance of the risk-free asset over the standard deviation of the risk-free asset. Remember, we said that when it's risk-free, the standard deviation is what? 0, right? 0. So similarly, the correlation between any risky asset and the risk-free asset would also be 0. And these little what you call it now? These little reminders are important. And I said they're important because they represent the kind of question one might ask. Combining a risk-free asset with a risky portfolio, M. The expected return, it is the weighted average of the two returns. The expected return of a portfolio is equal to the weight, right, of the asset. So if it's a risk-free asset, then it is the weighting of that risk-free asset in the portfolio, right, plus 1 minus the weighting of the risk-free asset times the return of the market. Okay? And the standard deviation, and the one, remember when you're talking about the expected return, it is the weighted average of the two returns. The weighting of the risk-free, right, plus the weighting of the expected return of the market. Why? Because it all adds up to 1. So the weighting of the risk-free, right, 1 minus the weighting of the risk-free will give you the weighting of the rest of the assets in the portfolio. Standard deviation, applying the two asset standard deviation formula, right, we will have the standard deviation of the portfolio is equal to the weighting of the risk-free asset. But hey, we are not getting into this. We are not getting into this. What is important is to remember that if you are the standard deviation, the standard deviation of the risk-free asset is equal to 0. The standard deviation of the portfolio is going to be equal to 1 minus the weighting of the risk-free asset times the standard deviation of the market. This is what we need to recall. And remember that because let's go back here, because the risk-free asset, the correlation between a risky asset and the risk-free asset is going to be 0. And here, it's always the portfolio, the return for the risk-free asset, right? The covariance between the risk-free asset and any risky asset or portfolio, it's always 0. That's all you have to remember. So once they have in there that it is the risk-free asset, then the answer is going to be 0. All right. Developing the capital market line. With these results, we can develop the risk-return relationship between the expected return of the portfolio and the standard deviation of the portfolio. The expected return of the portfolio is equal to the risk-free rate plus the standard deviation of the portfolio times the expected return of the market minus the risk-free rate over the standard deviation of the market. And this relationship holds for every combination of the risk-free asset with any collection of risky assets. However, when the risky portfolio M is the market containing all risky assets held anywhere in the marketplace, this linear relationship is called the capital market line, always. And this is what we've been looking at here, the capital market line. Well, here we are. Okay. And here it is. This is the capital market line. This is the risk-free rate, which is this space from 0. You know, whether the risk-free, the government security is paying you 5%, that's 5%. And this return is above 5%, which is the expected return of the portfolio. And these points are the risk, or rather standard deviation of the portfolio listed here. And so what we're saying is that each one of these, for to be in equilibrium, you expect it to be on the capital market line. And this Markowitz calls it the efficient frontier. And what he says, is that it is not efficient unless it is on the capital market line. Because if it's not on the capital market line, then the security is either undervalued or overvalued. And what happens is that the investor would always be seeking the capital market line, the investors, because the pressure would be on to ensure that they are receiving the return that they expect for the risk that they expect. And here it is in equilibrium. This is the market return, M. So you may have other investments that are providing another return, right, than the market return, providing other based on other risk levels. And here they're saying is that at this point, you could find that if this is the risk-free rate, an individual has an opportunity to borrow money at the risk-free rate and lend it out to earn a higher return. And would have taken additional risk, because here it is, you have lent the money out, so you're taking additional risk to earn additional return, which is above your frontier, ideally. But of course, remember that this is the equilibrium point. So What it says is that one can attain a higher expected return than is available at point M. So here is the expected return. But they're saying that you can earn a higher return than the market rate here. One can invest along the efficient frontier beyond point M, such as point D. Here we are. With the risk-free asset, one can add leverage to the portfolio by borrowing money at the risk-free rate and investing in the risky portfolio at point M to achieve a point like E. Clearly, E dominates D. E dominates D. Similarly, one can reduce the investment risk by lending money at the risk-free asset to reach points like C. Risk-free asset. But here you are to reach, this is the security market line. But this is the capital market line. Taking into consideration all the risks that are available. So at this level of risk here, because the capital market line, the risk that the investor is prepared to take is higher than the efficient frontier. That and of course the security market line is made up of several of these curves, you know, and you're always seeking, the market is always seeking an equilibrium point. But an investor at any point in time can be earning a return, right? Which is not the equilibrium point. Pardon me. And here we are, right? The capital market line, assuming lending or borrowing at the risk-free rate. So this is where the market is, right? And so what you find is that anywhere between the risk-free rate, right, and the equilibrium point, individuals could actually be lending money here. And what will happen is that they will be borrowing at the higher rate. So they're lending, because this is the difference, the risk-free rate and the capital market line. This shows you the amount that at any point in time an individual could be lending money, right? Because what is happening is that this efficiency curve here, this is the equilibrium point at the market where you're earning a return that's equal to your level of risk. And down here, all these points here, right, represent where individuals are getting returns, right? That is below the market for the same level of risk, right? So because portfolio M lies at the point of tangency, it is the highest portfolio possibility. Here it is. Everybody will want to borrow in portfolio M, invest in portfolio M, and borrow or lend to be somewhere on the capital market line. It must include all risky assets. And since the market is in equilibrium, all assets in this portfolio are in proportion to their market values. Because it contains all risky assets, it is a completely diversified portfolio, which means that all unique risks of individual assets is diversified away at that point, at this point. All right. And systematic risk, it remains in the market. It is the variability of all risky assets caused by macroeconomic variables, the variability of growth in the money supply, interest rate volatility, the variability in factors like industrial production, corporate earnings, and cash flow. And the systematic risk can be measured by the standard deviation of returns of the market portfolio. And of course, it can change over time. And how to measure diversification. All portfolios on the capital market line are perfectly positively correlated with each other and with the completely diversified market portfolio M. That is, a completely diversified portfolio would have a correlation with the market of 1. The reason is that complete risk diversification means elimination of all unsystematic or unique risk, and the systematic risk correlates perfectly with the market. Okay. I don't know if you recall that we talked about the fact that in identifying securities for a portfolio, ideally, we would be looking at those securities that will be below 1 and above 1. The ones that move more aggressively than market, which would be above 1, and those that moved slower, less aggressively than the market, they had less risk. And so the ideally one would like to have a portfolio that blends the two of them. So in actuality, you get a situation where the portfolio is perfectly correlated with the market and moving as the market moves. Okay. Diversification and the elimination of unsystematic risk. The purpose of diversification is to reduce the standard deviation of the total portfolio. And this assumes that imperfect correlations exist among securities. As you add securities, you expect the average covariance of the portfolio to decline. And with many securities, the more you add to obtain, and how many you would add to obtain a completely diversified portfolio? Well, here we have the number of stocks, and what this is graphically showing is that the more securities that you add to the portfolio is the more you are reducing the unsystematic risk, right? Until you get to a point where you can no longer reduce the risk anymore. And what you're left with is the systematic risk, the undiversifiable risk, right? And here we'll see the tendency. And what they're doing here is showing you this relationship when we talk about 20 to 30 stocks in your portfolio. That's really what is happening here, so that you are diversifying away as much of the risk as you can. And this line here represents, for this portfolio, the systematic risk that has to be considered in determining a return. The capital market line and the separation theorem. The capital market line leads all investors to invest in M, the portfolio, Individual investors should differ in position on the line depending on their risk preferences. Whoops. An investor gets to a point on the capital market line based on their financing decisions. Risk-averse investors will lend at the risk-free rate, while investors preferring more risk borrow funds at the risk-free rate and invest in the market portfolio. The investment decision of choosing the point on the capital market line is separate from the financing decision of reaching there through either lending or borrowing. A risk measure of the capital market line, the Markowitz portfolio model considers the average covariance of all other assets. The only important consideration is the asset's covariance with the market portfolio, and covariance with the market portfolio is the systematic risk of an asset. Variance of a risky asset I at a point in time is equal to the variance where the slope or the risk, which is the slope, times the return of the market at a particular point in time, plus some error. There's always an error. So suppose you have a riskless security earning 4%. And the market portfolio, where did I go? And a market portfolio with a return of 9% and a standard deviation of 10%. How should you go about investing your money so that your investment will have a risk level of 15%? So the portfolio return, the expected return of the portfolio, right, is equal to the risk-free rate plus the standard deviation of the portfolio times the expected return of the market minus the risk-free rate over the standard deviation of the market. So when you substitute for these items, so here it is, you had a riskless security. And what is a riskless security? Nothing more than the risk-free rate. It's riskless, right? And it's earning 4%. And the market portfolio is earning 9 with a standard deviation of 10. So here we have the risk-free rate of 4% plus the standard deviation of 15 times the portfolio return of the market minus the risk-free rate. And they always talk about the risk-free rate because really what you want to get at is what the investor has priced their risk at. And this is what they need to return just to satisfy them for the risk taken over the standard deviation. And what they're saying is that you would expect that you're going to get 11.5% as the return on the portfolio. So money invested in a riskless security, right? The return that you'd expect to get from the portfolio is 11.5%. which is equal to the risk-free rate, the weighting of the risk-free rate of 4%. And you don't know what the weighting is, you see. Plus 1 minus the weighting of the risk-free rate times 9%, which is the market return. And so what we're saying is the weighting for the risk-free rate is turning out to be negative 0.5. And so the investment strategy is to borrow 50% and invest 150% of the equity in the market portfolio. So if it is negative 0.5, right, then 50% it brings it to 1, right? And you're earning 150% return on this money. Because here you are, the investment strategy is to borrow, right, 50% and invest 150% in the market portfolio. 11.5 is the return you want. And for you to get that return, you have to invest 0.5, negative 0.5 to earn 4%. Plus, if this is negative 0.5, then this must be 150. Okay? A concept.
Shirley,
Oops. Yes.
Yeah, it has. I'm not sure if you're able to see the timeline.
Sorry. Oh, I apologize. I was having fun here. I apologize. Let me see. Woo, woo, woo.
Is there
Let's
like an estimated time when we can
I'm at 2:08.
so we're 8:48 p.m. now. So
All right,
yeah.
all right,
Are we
all
going
right,
up
all
until
right.
9 or
I think that we should be done by 9 because I just go to this summary and then all you'll be left to look at is the other kinds of risks, which would be business risk and the risks that would you could calculate from the balance sheet and the P&L, which are the normal kinds of ratios, right? You should look at that. And where I am here,
alrighty.
yes, I'll soon be finished this section because really it is just the capital market line that I'm talking about, and really the covariance, right? The correlation of coefficient, which we did, right? And what it represents, the ratio of the standard deviation to the mean, and it is a useful statistic for comparing the degree of variation from one data series to another, even if the means are drastically different one from another. That's what this calculation does. And this is the relative standard deviation of dispersion of data points around the mean relative to the riskiness of the investment. So that one is important, the correlation of coefficient. And the capital market, let me just deal with this one here, which is this calculation, which is what we looked at. And a conceptual development here is the existence of a risk-free asset resulted in deriving a capital market line that became the relevant frontier. However, it cannot be used to measure the expected return of an individual asset. The individual asset or portfolio, the relevant measure is the covariance with the market. And that is for individual asset I, the relevant risk is the standard deviation of I, but rather, not that, but rather how it relates to the market. So the standard deviation of I to the market, right? Where the return on the market is the correlation coefficient between the two. So what you're going to be looking at is the covariance of these two securities over the standard deviation times of one times the standard deviation of the other. And that is the correlation coefficient. So I'm pretty much done with these, what I call the numbers. the ratio that you need to be able to calculate, I think. Because I don't set the paper. But the capital pricing model talks about the coefficient of variation, which represents a ratio of the standard deviation to the mean, and it is a useful statistic for comparing the degree of variation from one data series to the other. Right? This is the relative standard deviation of the dispersion of data points around the mean. And remember earlier on, we talked about the reason why we didn't use standard, we did not use the standard deviation anymore because of this assumption that everything was around the mean. It didn't take into consideration skewness and so on. And so, of course, we have all these other factors that we use to do the calculation. And we spoke about that in our first gathering, remember, our first session. So really what this is just explaining that aspect. And then after this, right, this is it here. Standard deviation of return or expected rate of return, and the coefficient of variation here. Very easy, right? And we talked about the security market line already, right? And we did all this already. We actually looked at this already. So really, we are reviewing. And then, and what this is talking about beta changing over time. So beta has to be given. So the assumption of capital market theory expand on those of the Markowitz portfolio model to include consideration of risk-free rate. The dominant investment opportunity is the line tangential to the efficient frontier, known as the capital market line. Investors can move along it by investing in both risk-free risk-free rate and market portfolio through either lending or borrowing. And the relevant risk measure for an individual risky asset is its systematic risk, right, or covariance with the market portfolio. The security market line is derived to show the relationship between the required return and its systematic risk for any risky asset. And assuming security markets are not always completely efficient, you can identify undervalued or overvalued securities by comparing your estimate of the rate of return on the investment to the required rate of return. And when we relax several of the major assumptions of the capital market, the capital asset pricing model, the required modifications are relatively minor and do not change the overall concept of the model. Betas of individual stocks are not stable, while portfolio betas are. And there is a controversy between the relationship between beta and the rate of return on stocks, and changing the proxy for the market portfolio results in significant differences in the betas, the security market lines, and the expected returns, because they relate to each other, the numbers. So then the next item is the risk analysis, which examines uncertainty of income flows for the total firm and for the individual sources of capital, whether it's debt, preferred stock, or common stock. And so therefore, what this speaks to is the total risk of the firm has two components, business risk and financial risk. And what we're going to do is we're going to look at the different business risks. We're going to look at the different financial risks. And then the next thing they're going to talk about are the ratios. So I leave that to you folks to make time to go over them. Okay? And I know that the balance sheet ratios are things that are not unusual to you, and these are things that you're probably quite familiar with. Okay? So I think that we can. Hello?
Yeah, I'm just trying to get some clarity as well. Will there be some guidance in terms of what will be coming in the exam?
No information has been given on what comes on the exam. Nothing. It has never been provided. And that is why I try to go through everything, because having put together the material, it goes to London and they decide what the questions are. And that has never been shared with me. I'm teaching this from 2008. I have never seen a paper. Hello?
Yes, sorry.
Okay, but what you're saying, okay, I was just confirming, you said the paper is prepared based on what you sent to them?
Yes, this
Okay.
material. Yes.
Okay.
But what you have to bear in mind is that the final paper, right? You have a project to do, and then you have a final exam, which is multiple choice. And the multiple choice is coming from all of the material that you have learned in this program. And so you don't know, you may end up with 10 or 15 questions from this section. And they're multiple choice. So I always say concentrate on the Basel, because you must bear in mind that it's an international exam. And so Basel is an international expectation of its impact on the financial sector. And this whole matter of dealing with liquidity risk is very important, a very important facet. And so the whole matter of the doing the testing, right? That's very important. The guidelines, and I would say that if you're in the sector and you're working in risk management, reflect on some of the things that you have to do, because risk management for liquidity and market has to be part of the way in which the business operates. And so therefore the policies and procedures as approved by the board have to be part and parcel of how the organization operates. And the main thing is to look at the guidelines, to look at I would say that it's important to know that the 25 or 30 securities allow you the kind of risk minimization, you know, and also I would say that things like the liquidity management principles, I would say that those, I mean, I'm just thinking in terms of the things that I would consider important, because this is not a West Indian or a Jamaican course, it's an international course. So it's going to be focused more on those matters. That is the guidance that I would give you. Okay.
Dr. Lee, I'm sorry, I lost power for a minute. Did you mention something about a project? Did you expound on it?
They were supposed to, you have not received that?
No.
Oh, okay. Well, unless I know they didn't offer the course last year. I don't know if they have changed. They have changed it, but I recall that was going to be, let me hold on a minute, let me pull up the email.
Yeah, I think there was a guide sent as it relates to the breakdown of the course assessment, broken into the an assessment and then an examination, right?
Yes.
I think sometime in July is when they will release, or we would have
They will give it to you. They will tell you what it is. Because investment and liquidity risk, see, they have here a Zoom and apart from the Zoom invitations, you're going to get October. We have there's some kind of project that they're going to give you to do. And they may not have provided that information to you yet, but it's something that you work on in light of the information that you would have gleaned from the various. See here, it says there's going to be a personal assignment which will be due to commence July 22nd, right? And this grade, along with the exam, which will be held in November, will make up your final grade. The personal assignment, which is 2,000 words and will count 40% to the final grade. And the final exam will be made of 70 multiple choice questions pulled from the 6 modules. So that's why I'm saying that I would expect that, assuming that they treat each module equally, you may find about perhaps 10 questions coming from this module or from each module, okay? And the information, that's why I focus, that's why I'm saying that the personal assignment, they haven't said what they're going to set at this point in time, okay? But it certainly would have something to do with risk. And it's something that this one is 2,000 words. So you're going to have to prepare something, write something on that. And they call it a personal assignment. So I don't know, I really can't even tell you, except to say that it is going to be utilizing the information that you have across the various, it's going to be pulled from each one of the topics. Each module is going to feed into it, but it's going to be the information that would be gleaned, certainly not after the 22nd. So therefore, on the 22nd, would you be done? 22nd of July?
No, we go up until September, and then
You have
we have
credit and up.
March.
Yes. So in other words, you're going to get something that is going to pull on enterprise risk management and investment and liquidity risk and reputational risk and corporate governance, because you would have completed those topics, and you're going to be asked to write something. So clearly it's going to be, I would think that it's going to be something that has to do with risk management. Okay? And then you have your final exam with 70 multiple choice questions coming from the all areas. So that is as much as I can tell you at this point in time. But what you can recognize is that the reputational risk and corporate governance, the enterprise risk management, investment and liquidity risk, and credit and operational risk, which you would have completed, right? They all relate to each other. They all relate to each other, because really what you're doing is it is in the area of risk management for the business, for the bank, or whatever your personal discussion is. So they're going to give that to you, and it's going to be given to you on the 22nd of July, right? commencing on the 22nd of July. So therefore, it's going to certainly be a paper that takes into consideration the information that you would have learned along with this course. Okay? Does that help?
Okay.
Yeah, it helps. And in the dashboard, in terms of, I see on the dashboard there's a schedule as well in terms of the course schedule.
Yes.
I heard you mention about going through credit and operational risk. We haven't, I don't think we've reached operational risk thus far.
I think that's it. That's the next module.
Yeah,
That's
that's
the
the
next module.
Yeah.
And so what I'm saying is that by the time they tell you or give you the information for you to start your personal dissertation, you would have completed those risk elements. But
No, it's actually scheduled
starts-
to be given to us the day when
we
credit
start
and
the credit and
operation
operations.
starts.
but it's not due then, you're getting it then. So it really will pull on the whole body of work, I think, that you're receiving in terms of risk, because remember, that's what it is. That's what the course is all about. It's international risk management. And so that's why I'm saying that I would recommend that you give attention to the Basel framework, because that's international risk management, guided out of for the international bankers. And certainly the whole matter of what risk is, and what probably it would be something that because it says personal, so it may very well ask you to take a position and make some recommendation based on what you have learned or will learn. So at least they give it to you halfway, so you would have already covered some modules, and you still have some more modules to do. Okay. So that's why I don't, although I talk about some Jamaican examples and so on, and I talk about Silicon Valley, to the extent that those are international situations that everybody had their eyes on, and so that's why I use it. The information that I give and I cite what is said by Bank of Jamaica and so on is really just to provide examples, of how a jurisdiction, what a jurisdiction has done. But it's just an example of how any one of these regulated and regulatory entities would operate. So the whole matter of investment and liquidity risk, what it is, how it's described, what the example of Silicon Valley, and certainly the whole failure, and the fact that even though the rating, bank ratings, which is the CAMELS, which you will learn if you haven't done it already in one of the others, that talks about capital assets and management and earnings and how important that is in managing the organization's risk, and liquidity risk management, what the principles are. That is something I think that is going to, you're going to be asked to pull out all of this to put together your paper. That's how I think that they're going to make it work. And certainly the whole matter of stress testing and how important it is, and in any organization, and to make sure that in fact you have covered, you have 100% coverage of the the potential outflows of your cash. That I think is very important. Um, because right now the whole matter of capital adequacy and liquidity management is what the global banking industry is focused on. And I would suspect it's from that perspective they're going to ask you to put some documentation together with respect to your own ideas.
Yeah, I didn't, well, we didn't really touch on an internal capital adequacy assessment process, like an
Mhm.
ICAP process. But I a lot of the things that you touched on basically refer to the ICAP process as well. So I don't think we really touched on specifically the ICAP, but I thought it would be necessary to even touch on that specifically.
Because in terms of my area of investment and liquidity risk, the capital adequacy comes out of Basel. The Basel,
Yeah, yeah,
yeah,
the standard, yeah.
they're the ones that have identified what is supposed to be the capital plus the buffers, which is going up to 7%. Um, and that is a requirement for all banks. Excuse me. And even if the central bank in a particular jurisdiction has not implemented it, because remember, as we say, it all has to do with their own resourcing and their own political situation in a jurisdiction. But because the banking business is international, what you find is that to have a relationship with a corresponding bank, you're forced to implement the same standards, because what is happening now is that if you don't do it, they don't want you as a customer. So that is how they get you. So even in our own jurisdiction in Jamaica, we have started to look at the whole matter of Basel III for implementation. But of course, you have to the central banker has to be mindful of the resources of our own banking system. And that is what happens throughout the world, you know. That's what happened throughout the world, because even in the United States, when they brought in Basel III, Basel II wasn't in place yet, and that is because the government of the day determines what the citizenry will tolerate. So that's why I'm saying focus on Basel III, the changes that have been made, and the capital adequacy. And then when you talk about the liquidity management, you can talk about stress testing and what management is expected to do and how it is supposed to be incorporated in the banks. I would think that is where I would put that. They must bear in mind too that somebody else is going to be handling the let me find this thing. Somebody else is going to be doing credit and operational risk. That starts on the 22nd. And you would have already done something on enterprise risk management, right? Yes, you'd have done enterprise risk management already. And that is how to design the whole create the risk registers for the organization based on and probably how to identify the checks and balances you put in place to ameliorate those risks. Reputational risk and corporate governance, investment and liquidity risk, and credit and operational risk. you have that to do as well, which is why even when we're talking about the um, the identification of the the cash needs and so on, I didn't delve into that because I would expect that that is going to be handled at that in that presentation. So, okay. That's it. And then we have revision sessions in October as well. So, all right. So what I would suggest you do is that if there is a particular area of interest when we meet to do the revision, please bring it and then we can try to incorporate it. It's about an hour that we have together, but we can quickly go over some of the topics. And as I say, the main ones for me are really how to implement the risk management for liquidity risk and investment in-house. And what is liquidity risk and how to measure it, you know, and what are the measures used. And because the test is multiple choice, that's why it's more focused. My focus is more on what it is and what it means, because that is really what will probably be the focus. And that's what I've been doing these years. So I think I'm on the right path. Okay, so
Rosalie, before you go, the presentation that you are using tonight, I noticed that it's 2 slides less than what's in the Dropbox.
really,
So I'm
which
just wondering if
two?
I don't know which 2. I just know in the one I had downloaded is 258 slides and you're at 260. So I'm wondering if you could drop this one instead. Because I think you may have probably made some adjustments, but it was just not
Oh,
uploaded.
yes, because every year I tweak it. But you can't tell me which 2 I left out.
No, no.
Oh,
No, it looked like you added 2 slides, but I don't know where they are.
yeah, but I'm not going to go back on year before
No,
last.
I'm just saying that if you could give them this breakdown, so let them replace what is in the Dropbox with this.
Okay. Oh, huh? Well, I don't know what they did because what I'm using is what I gave them. I haven't made any changes since I emailed it.
Okay.
So I don't know. I don't know. I hope they're not. Oh, but then,
We haven't made
remember
any
now.
changes.
Remember,
Go ahead. Sorry.
I don't know if because they added their GIFs at the front and so on, that would have given certainly that would be one additional slide. Hmm?
Yeah, but we haven't made any changes to the module. It's the same module as last year. It's just that we have made it visible now to you guys. So I can't say as to why exactly there was a difference in like the page numbers.
I don't know. The only thing the only thing I said you would have added is your company logo and so on the front.
Yeah, or it could be just the font size, you know.
Oh, I know what the 2 different ones are. Um, I know where the difference comes. What I have done is I have put in what I call review slides. So after the
Oh.
first session, I put in a review slide and I said, this is what we talked about last time. That's the only thing that I've added.
Oh, okay.
Yes. So that's what I do. And so I have two slides in, and what I do is I reflect, I look back and I say, okay, and I have to put it in when after the sessions, because I'm never quite sure on exactly where I'm going to end. So I wait until we have completed the session, and I put a slide 85 I slipped in, which I say recap first session. And I put, we did an overview of investment liquidity and what is liquidity. We looked at the Silicon Valley collapse example, the measures of risk, VAR, standard deviation, beta, Sharpe ratio, and duration, and measures of liquidity risk, liquidity coverage ratios, net stable funding ratio, liquidity gap analysis, principles of liquidity management. And then we looked at stress testing. And I said, why? Risk management. We have to monitor, we have to mitigate the strategies. So that I inserted as a recap of the first session. And then when we finished last week, I put in another one which said recap of the second session. So that's why it's different. It's not that I've changed anything. Okay? It's just my way of reminding everyone what we talked about last time.
Okay, I will make a note of that as well. All right.
Yes. Okay. So that's why it's two more.
All right, Shirley. So I go ahead and stop the recording. Is this where the ending?
Yes. If you want me to send you those two slides, I can, and you insert them, or
Yeah.
just send, or I'll send you this one because it's inserted in there. The recap slides.
Yeah, you can.
Come on, that's fine. That's fine.
All right. Okay. I'll send you that, and I'll also include the capital market case, which I didn't use this time, but I made reference to it. So let me include it so that they can see it. So I will put those, I'll give you those things. I'll send them into you. I have to do it tonight because I'm doing surgery tomorrow. I won't be in any state to do anything.
Oh.
Okay. Yes. So I will send them off. I look for them and send them off now.
All right. You can send them to info@GISJM.
Info.
Yes.
All right.
All righty, Miss Shirley. All the best on your surgery tomorrow too.
Thank you very much.
You're welcome.
Okay. All right, everyone. I'll see you again in when is it now? October? I think it is October.
Yeah,
Bye.
October for revision. Yeah.
For revision, yes.
All
I'll
right.
Bye,
see you
Mrs.
again.
Shirley Oxley, and thank you very much for 3 very interesting weeks.
It's a great topic, This area is a great topic, and no matter what technology they bring in, because the technology is always part of of banking, but this whole matter of managing the risk is it gets even more complex as time passes. Yeah. Okay. Bye, everyone. Bye for now.
Bye. Take care.
Everyone.
Yeah.